You have to be amazed that I was able to make a GDP number actually interesting, right? No, just kidding. Hello, welcome to this episode of Rich Insights. I'm Don Rich, head of investments for Esoterica Capital Markets. Today's topic is on the first quarter GDP number, right? Q1 2020. We printed a negative 4.8%. Now what we're going to do, we're going to tear this number apart. We're going to make sense of it. We're going to make economics interesting, folks. This is really interesting stuff. I'm going to walk you through it. It's actually very simple. It sounds dry, it sounds boring, but stick with me. Stick with me. It's anything but. All right? So the market was expecting minus 4%. We came in at minus 4.8, right? Came in at almost minus 5. So that means, again, the economy has declined 5% from, almost 5% from the previous quarter, the fourth quarter. So the two main questions are, how does that minus 4.8% stack up against history? Right? Just how big of a negative number is that? And the second thing is, we want to tear it apart. What is it driving that minus 4.8%? So let's go to the charts here. All right, we're going to start here. We're going to start getting quarter on quarter because that's what we're all most used to hearing about, thinking about, and so forth. This is the minus 4.8, all right? That's our observation here for Q1. And the dotted line then tells us, helps us see how it compares to previous times in history. All right, and if you actually count these sticks down here at the bottom, you will see that this is the seventh worst. The seventh. All right, we're going back, folks, to 1950. All right, so we got some 70 plus years in this chart, and we're at the seventh worst on Q1. Now, we know Q2 is going to be worse. In fact, we know it's going to be substantially worse. So we're starting at the seventh lowest point, and all we're going to do from there is go further and further. This is really, really a historic slowdown that we're talking about here. All right, so that's quarter on quarter. Now, we're going to go year on year. On a year-on-year basis, it's a slightly positive number, 0.3%. All right, so the economy slightly bigger than it was a year ago in the first quarter. Now, notice that this chart actually has the demarcation line here at 2%. Right? Why is it 2%? Well, historically, if year on year has fallen below 2%, then that's a bad sign. That's a bad sign. We start to worry about recessionary environments. All right. You can see there have been a few times here recently, a few times where we have fallen below the magical 2%, and it hasn't. And these times it has not resulted in a recession. But you can also see that when we're down here, these do tend to be recessionary environments. So whether we look at it quarter on quarter, that's a recessionary indicator. Year on year, it tells us we're most likely in a recession as we speak. All right, so that's what the minus 4.8 looks like over time. That helps us put it in perspective over time. Now let's tear it apart. What is driving this? All right, to answer that question, I like to take the GDP number and break it up into 6 pieces. All right, now each of these 6 pieces then are going to add up to the overall GDP number. All right, let's start over here on the right-hand side. This chart, this analysis goes back to 1984. Since 1984, the average GDP for a quarter has been 2.7%. See, 2.68, right? Almost 2.7%. Now, out of that, 1.87 was due to the consumer. All right. Again, these numbers add up. So 1.87 of the 2.68, or 70% of GDP since 1984, has been due to consumer spending. The next most important component has been business spending. It's about 0.5% each quarter it adds to GDP. Government spending, the third line here, contributes about 1/3% to GDP. Now notice these bottom 3 lines. these tend to be very close to zero over the long run. These tend to be close to zero. They really don't add much or detract much to GDP. Okay, so where are we at today? Our headline number minus 4.8, and I'm going to tell you the punchline here before we go through it. The details are even more depressing than the headline number. All right, and the reason for that is if the GDP was just based on consumer spending alone, we would have printed a GDP number of negative 5.26. All right. If we forget about everything else and just focus on the consumer, the GDP number would not have been 4.8. It would have been negative 5.26. All right. Substantially worse. Now, next, you also see business spending was another big drag. It subtracted about 1.2% of GDP. And it has been a detractor here the last few quarters. Now, why is that? Well, businesses, again, have been reducing their spending. They've been increasing their buyback programs. And this is a concern I've talked about many times. It continues to be a concern. Now, we got to add to this concern, right? Because the biggest component of corporate spending tends to be from the energy industry. And the energy industry is just not spending on R&D when we have $12 and $14 oil. So this is a big negative number, and we can expect that big negative number to continue for at least the next few quarters here as we evolve through time. Government spending was a small positive due to the stimulus programs. All right, net trade. You say, well, net trade, that's a piece of good news, right, Fat Man? Right? It added 1.3% to GDP. Well, unfortunately, the answer is no. No, boys and girls, this is not a good number. Okay, so net trade is exports minus imports. Both of them are falling very rapidly right now. They're both collapsing. And it turns out that imports are falling faster than exports. That's why it looks like it's a good number. It looks to be, that's why it's positive. That looks to why it should be a good thing. But the reason imports are falling faster than exports is because largely because of oil. We're not importing near as much oil today as we used to because the U.S. has started to produce more and more. And also, we're just consuming less given the social distancing. So this is not a good piece of information either. Down here, inventories. Inventories were a drag. They have been a drag. You can see the last few quarters. I would expect they're going to continue to be a drag, folks. You hear again about the oil industry. We're sitting on record amounts of inventory. Gasoline, we're at record levels of inventory. Durable good inventories are quite high. New car inventories quite high right now. We still have a lot of inventory to work off here, folks. So this has been negative, expected to continue to be negative. Now remember, part of the reason we had that buildup in inventory in the past is because there was concern over the tariff and trade concerns. And we thought at the time building up inventories, filling those warehouses was a good thing. Now we're finding, oh boy, that's a problem. That's a problem, right? Now we find ourselves sitting on a lot of inventory we got to work off going forward here. All right, let's go to the final chart here. Since personal consumption, since consumer spending is so important, I wanted just to look at highlight this one over time here. So on this chart here, we're looking at personal spending on a year-on-year basis, and obviously it's weak. And again, next quarter we know it's going to be much weaker. But even at the level that it's at, it is still pretty darn weak from a historical perspective. So let's pull this all together. What are we supposed to make of this? Well, one, you have to be amazed that I was able to make a GDP number actually interesting, right? No, just kidding. What do we make of this number? Right? There's no good news in this number whatsoever. Yeah, we know, it disappointed. The guts are even weaker than the headline, and we know in the future things are even going to get worse. Right? The second quarter numbers are going to be substantially worse than these. All right, no good information here whatsoever. And yet, This equity relief rally continues. This really concerns me. I think the market's getting way ahead of itself right now. We don't have a whole lot of macroeconomic data to tell us how bad the slowdown is. What we do have, like I just presented to you, is not good. There is nothing in it that you can get excited about. So if you put the equity market performance alongside this, you really got to be concerned about the market being too far out in front of itself right now. All right, so that's our message for today. I'm Don Rich. You've just experienced a rich insight. I hope you've enjoyed it. May your beer be colder than the company you keep. We'll talk again soon. Thank you.